Welcome to the Legacy Leaders Podcast. Are you doing the best for your client to help them create their legacy? Are you creating a plan that goes far beyond finances to help people ensure that it becomes the driving force behind all decisions? On this podcast, hosts Katie Beth Hand and Stan Miller will help you with growing your practice and your clients' peace of mind. Together, they bring the best and brightest minds to share with you how to help your clients develop their best legacy. And now, here are your hosts, Katie Beth and Stan.
Welcome back to the Legacy Leaders Podcast with your hosts, Stan Miller and Katie Beth Hand. Today's guest is attorney Addison Adams. Addison is not just the founder of Adams Corporate Law, but he is also California's go-to voice on mergers and acquisitions. Addison, thank you so much for joining us on the show today.
Thank you for having me. It's a pleasure to be here.
Absolutely. So let's just dive right in. And I would love for our listeners who may not have heard about you and the work that you do, will you start at the beginning for a few minutes and talk to us a little bit about your background and what got you into this industry and the area of law that you practice and really what that backstory is like for you?
Well, sure. I'm always happy to talk about myself and my background. So thanks for the opening. I'm the lawyer that closes deals. I'm a corporate transactional attorney. I'm a securities attorney, meaning SEC compliance. And I close the purchase and sale of businesses. I close investor financings. I close joint venture agreements. I close important material customer distribution contracts. I am an outside general counsel for businesses and business owners. And I write contracts, help negotiate deals, and help get them closed to protect the client's interest. That's what I do. That's what I've done. That's what I've been doing almost 30 years now as an attorney based in California. And I have my own firm, started 9 years ago after leaving a larger boutique firm that I also helped grow from a small number of lawyers to a large number of lawyers. And we did the same thing there. I got into this in the dot-com boom of the 90s, which those of us old enough to remember may see some analogies to the current AI boom of the 2020s. But yeah, so a lot of venture capital transactions happening back then. And I just love it. I love closing deals. I love negotiating the deals. I love how it's a win-win if you do it right. The buyer of the business is, excited to close the company and grow it to something bigger. The investor in the business is excited to get a great return. And the entrepreneur that's either getting the financing or selling the business because it's the right time, they're retiring, they're moving on to some other business. It's just, sure, negotiations can be heated sometimes, but I think that it's just such a great opportunity to be an advisor, a helper, to get in there and keep everyone focused on why we're here in the first place, which is mutual success, a win-win scenario. So that's how I got into it. That's what makes me tick.
Yes, I love that. And I love on your website, which we will link into the show notes for everybody who is listening. I love that it starts right at the top. It says lawyers who close deals. There is no question about what it is and what did you do. So I love the clarity your website has. Talk to us a little bit about you're the go-to voice on mergers and acquisitions. So talk to us a little bit about your stories, your insights, and your tips from all of your experiences as being the go-to M&A deal maker.
Sure, happy to do that. Selling a business or buying a business, either way, can be very scary because of the unknown. If you're the seller, a lot of times it's the first time, and maybe the only time you're selling your business. A lot of these are because person's built the business over 20, 30, 40 years. It's a big deal. It's their biggest investments. It's their life's work. It's a legacy. And they know how to run their business, that's for sure, but they don't know how to sell it. They don't know what to worry about. And one of the tips and tricks I bring in is simply the experience of being a guide. Say, I've done this hundreds of times before. Let me just tell you what's coming. Let me walk you through where we're going to be paying attention, where we're going to be giving in, that kind of thing. And similarly, on the buy side has a bunch of stress as well. They're putting up millions of dollars to buy something that they don't have 30 years of experience with. They're hoping they're not buying a lemon, right? And so they're asking a lot of questions and hoping to get truthful answers, hoping there's no sandbagging going on. And so there's some concerns on both sides. And the tip and trick I have to smooth the gears of the deal is openness, transparency, authenticity, and honesty, and competency in terms of knowing the seller has to know their business, and they usually do, but they don't always because sometimes their accounting is sloppy and they don't know that their balance sheet is completely wrong and they've got things in the wrong categories. And it matters to a sophisticated buyer, details around accounts receivable and recognition of income and things like that, which is why a lot of times you see outside quality of earnings come in from an accounting firm. And all these things are great things to do. Essentially, to answer the question, which is what are some tips and tricks to getting an mergers and acquisitions deal done? Um, on the buy side, ask a lot of questions, be organized, have experienced advisors, lawyer and accounting, and sometimes benefits and other expertises, environmental, depending on what the business is. And on the sell side, be organized, be prepared. So you can get a quality of earnings on your own, on yourself before you get into the transaction. You should have a proper accounting department. You should know that your accounting, financials are correct. Legally, you need to have agreements and they should be signed and you should be able to get your hands on them, the signed version of your material major contracts. Your cap table should be iron tight. There should be no giant gap. But yeah, we had a third partner for 10 years and he just left, but there's no paper. Like you need to have everything in order so that you don't get, what's that word in sports, like a self-inflicted wound. That's not the right reference, but unforced error, that kind of thing.
Right. Yeah.
That's it, unforced error. Yeah. So there's honestly, we could talk for, I think, weeks on this question as far as all the different ways you can prepare. But from a lawyer's point of view, it comes down to being open, honest, knowing what you're selling and making sure you've got all the dots dotted and T's crossed to show it. Like your IP is owned by the company that's selling the business, on and on and on. There's a long list. That's why I have a job and I actually there is literally a list where we go through every single thing to make sure that it's all buttoned up as part of the deal.
What are, from the seller side, what are some of the mistakes that you see that are most common from sellers that are trying to make this happen?
Hmm.
And it may be some of the list that you just talked us through, some of your tips and tricks and reminders, but what are some mistakes that you've seen?
So one of the bigger risks and one of the big mistakes sometimes that happens is when the target that they're buying is dominated by a strong personality, the founder, and the founder's fingerprints are just too deeply ingrained in every aspect of the business, the customer relationships, the employee relationships, everything. And this is pretty common. But when you have that, a big question for the buyer is how are we incentivizing that founder to be motivated and aligned with our interests to maintain all of the current customers, to maintain all of the key employees that are fantastic and help them get here. And so building in the right incentives for the founder, maybe with a transitional employment agreement, maybe with some incentive bonuses post closing, paying attention to the key employees and making sure that those people are properly motivated. These are opportunities, I think, for mistakes. And related to that idea of incentives and alignment is this idea of integration. And I have seen and am currently seeing it in more than one instance, a failure of the buyer to properly plan how are we going to fold this business into our business. And so that requires a ton of thought, and it's a business analysis, it's a operations analysis in terms of, and it goes a little deeper than just questioning whether there's overlapping roles in the higher levels or the back office. We don't need 14 bookkeepers now. We can maybe reduce that to 10. It's a culture question. It's a location where people work question. It's changes to benefits and expectations. So the idea of making sure that there's a good fit, and that's critical, I think, from the buyer's point of view. So a lot of times I have seen buyers where they look at the acquisition as a bolt-on and they'll just say, all right, we're not changing anything. That's going to stay in the same office. It's going to stay there. And that works, but it's also not really becoming part of the master vision of the overall organization. They're more just now you got all these satellite businesses. So yeah, so those are the two things that I see as a buyer. They're usually pretty good at asking questions and running due diligence and that kind of thing. But
No, that's good. That's great insight. So, from the seller side, when it comes to being a seller, you've got to have an exit strategy. Do you help clients with that? And what are some of the strategies and different tips and tools you walk them through to help them prepare to sell their business?
sure. So the idea of selling a business is very personal. And so people sell, a lot of times they don't sell, right? The business stays in the family, it gets handed down to generations. And because there are kids, grandkids, there are generations they hand it down to, and they're interested in running the business. And so the first question is, are we selling here? Is there a reason to sell? What is the reason? Is it retirement? Is it health? Is there some other issue with changing something about their personal life that's motivating the sale? And so once we understand that, then we can start talking a little bit about timing on their personal life. You can also, although not always, try to time it based on how the general market is doing, the economy, the industry. Rather, maybe we should wait 5 years. Maybe we should hurry up and sell before the tax law changes at the end of this year, that kind of questions. And then, price is a big question. I never think it should be the only question, meaning as important is who the buyer is. So finding the right buyer that's a credible, high integrity, good operating buyer that you trust, that you think your employees would like working for, that makes sense to you. But as far as, so either one of those, a lot of times the owner of the selling company, they know who their competitors are, they know who the bigger companies are. And I see a lot of times they feel like they can line this up on their own. And a lot of times they can and they do. But there is a benefit definitely to using a business broker or an investment banker to run a process for the right kind of company where you know that but maybe I've got good relationships with three potential buyers, but if we were to really open this up, I might get a lot more money and find an even better buyer that I wasn't aware was not in my industry, but really interested in getting into my industry. Right. And so I think just to repeat back the question to make sure I haven't strayed from it too far. Yeah. On the sell side, what can people do to get ready to sell? That's the pending question, correct? Yeah.
Right.
Yeah. So I think it's a great idea to talk to exit planning advisors, business consultants, investment bankers, business brokers, talk to everyone you can and hire quite a few of them, lawyers like me, good accounting. And the point of it is to increase the value of your business. And I'm a member of groups. I've received already a lot of training as far as being a good business owner, a good how to run a business. But just because you're good at your specific business doesn't mean you can't be better. And so getting the right advisors in there to essentially, maybe you should be ramping up sales. If you know you're selling in 3 years, maybe you need to put a lot of investment into hiring a great sales director. Maybe you need to think about, who knows, but someone needs to look at your business and give you feedback about maybe you should make some changes here. Maybe you've got too many product SKUs and you should have fewer, or maybe it's the other way around. Maybe you need to reduce your costs because you're manufacturing in the wrong spot. On and on, there's experts out there that can and should be consulted. So that goes a little beyond my pay grade, other than to say what I just said, which is that's a great idea. And if you don't know anybody, here's some people to talk to so that you are basically in the best position you can be, value wise, looking at your business from the perspective of a buyer. The buyer is going to be looking at multiples on earnings. They're going to be looking at product mix, client mix, percentages, how much is recurring revenue, how much is like a one-off. Basically, they're looking for your strengths and your weaknesses. So you should know what your strengths and your weaknesses are and try to improve on all of them.
Absolutely. Having the right team in place is always essential, I'm sure, especially coming into something like selling your business. So I love that. Stan, I have taken all of Addison's time so far, but I know you have questions. What questions do you have?
Yes, I want to follow up on a comment that you made a bit earlier in this conversation where you talked about how the founder of a business, which is really typical in my experience, the founder is really emotionally connected to the business. A lot of their personal identity is bound up in the business. And I'll tell you, one of the things I've found is that it's really a challenge sometimes to get the founder of a business to recognize that that their deep connection to the business is actually a liability when it comes to selling the business, because if the business is so dependent on this person, their presence, their connection to the business, that's number one. I think it's frightening to buyers, but also you have to think about what happens if this person gets run over and killed on the 405 on the way into to LAX. What happens to the value of the business when you lose that person? So I'm pretty sure, even though we haven't talked, I'm pretty sure you run into this issue a lot. And I'm wondering how you counsel these individuals on the front end to begin thinking about and making changes to the business in order to position it so that they're able to really maximize the value of the business.
Yeah, it's a great question. It's a great point. And it is very much a concern. It's an issue. And I handle it by asking a question about where we are in the process and what the timing is. And so if the proposed sale date is out in the future, a couple years, I might say to the founder something along the lines of, you should have enough lieutenants around you that you are able to take a vacation and completely disconnect for a full month or more, and everything will be fine, right? And if you can do that, then you know that it's, but if on the other hand, a lot of founders, they wake up at 6 a.m. and they're answering questions right until they go to bed at night. And so that's like a litmus test right there. And then I say, are you selling because you're retiring? If so, and you actually want to stop working, and you have a business that is so ingrained with you and your personality, and it needs you in order to have just maintain the same level of success, then you should sell a little earlier than you want to retire so that you can stick around for another 1, 2, or 3 years working as continuing as the CEO of this division for the buyer. And that will give you an opportunity over that transition period, number one, to make sure you get paid in full and you earn any deferred payments or earnouts that are part of the purchase price, which typically would only go for a couple years after the sale anyways. But also, that's a chance to make sure that you're doing a full and complete handoff of everything you're doing to whoever's replacing you that's working for the buyer. And so that is, you don't always have that luxury of pre-planning in advance, but a lot of people have a plan in their mind. They say, I want to stop working at age fill in the blank. Okay, let's back up from that. And if it's 65, then maybe you should sell your business when you're 62 and just assume you're going to get a 3-year employment contract. And then everything lines up in advance.
So, Addison, we're having this conversation in the spring of 2024. So far, the Fed has not given us the date on which they're going to start cutting interest rates. We have our own notions about when that's going to happen. And so help us understand what the rhythm is. What's the cycle or the pattern of business owners selling their business? Is there like a market timing that we ought to take into account here where we wait till interest rates get better? When you counsel a seller early on in the process, they're thinking about it. What's the thought process around how they time it?
It's a great question. I think that it's very difficult to time the market for the best possible price. It's also a good question to say which buyers are actually affected by the market and the industry. Clearly, private equity buyers are influenced by interest rates, and that's because they leverage the purchase price with bank financing to supplement their equity down payment. And if the interest rates go up, then their returns go down and their purchase price that pencils out for them based on your revenue and your earnings goes down. And so private equity transactions have been going down the last 2 years as a volume number as the interest rates have been going up. That's not always the case, though, with a strategic buyer. That might be a publicly traded multi-billion-dollar company. And if you're selling a business that's a $50 million business, that might be a rounding error for them, and they're actually not financing it. So they're just looking straight at what's the business worth, and here's the offer. So I do keep I guess, my finger on the pulse of what's happening with interest rates and with private equity and investment bankers. And so I have received a lot of prognostication about this year. And so the prevailing sentiment among quite a few, it seems like the majority of private equity fund managers, not all though, is that we are expecting 3 rate reductions this year, the first starting in June. And so we'll see if that comes true. There's also there is a lot of money that's been committed by limited partners in private equity funds that is aging out. And so it needs to be put to work soon, or else it'll have to be returned to the investors, which the fund managers prefer not to do because they're looking to put the money to work only if they get a great return.
Right.
And that way they can raise their next fund. And that's how you make money as a private fund manager. But the fact is, there's a lot of money on that sidelines, which means there's a lot of private equity that's looking for something good to buy. So there's a lot of that there, even with the tension caused by the higher interest rates. And then you have also a backlog of baby boomers that are at retirement age now that haven't sold yet. And so I've seen some charts that basically shows there's a lot of pent up sell side demand for founders that are ready to retire now or have been ready and they're hanging on for pricing to get better. And so we'll see. It is 2024 early, but and who knows what's going on in the world with all the everything, the wars and the economy and everything else. But I'm optimistic that it's going to be another busy year. Certainly my firm's been incredibly busy closing deal after deal the last 3 years, ever since COVID hit. It's just been through the roof. Although my firm's a smaller firm, it's a microcosm. If you look industry-wide statistics, 21 was the biggest year, and 22 and 23 were both smaller numbers.
So I just have one more question. I'm sure Katie Beth
Oh,
has some more too, but and my other question is this: what is it that's different today about your business than it was, let's say, 5 years ago? What's happened in this space that's different, and where do you see it going?
That's a fun question to ask. And my initial reaction is nothing's changed. It's all exactly the same. And there is a lot of truth to that. Lawyers, it's like birds of a feather flock together. So if you see a stock purchase agreement or an asset purchase agreement or merger agreement, they all have the same structure, the same sections, the same provisions, and it's been going on for decades. There's been talk about AI revolutionizing every single industry and business, and it probably will. It has not revolutionized the legal industry, at least not yet. We're still doing the same thing we've always done, which is get to know the business well, customize a deal that makes sense for it, and then tailor the sale documents.
Yeah. So yeah, let me follow on though. So I guess I'm asking maybe more about are the buyers different today than they were? Are you seeing more private equity firms buying business as opposed to individuals, or are you seeing more strategic relationships? Is there a shift there? And what's different about families? Are you seeing more family succession, or are the parents deciding my kids are not going to be interested in this, so I need to go find a private equity firm to sell this to because my son decided to become a neurosurgeon instead? Is that, looking back, maybe 5 years isn't a fair time frame, but looking back over time, is there a different, maybe a macro pattern that you see in who are the buyers, and also maybe how the financing is happening? Is it more owner financing now, or is it more bank financing? Yeah. Are there differences there?
Sure, great question. So what I'm seeing is it differs based on the value of the business. And so at the lower end of the spectrum, meaning the under $10 million deal size, we see a lot more individuals. We see a lot more SBA-backed financing to help finance these businesses. And so a lot of times at that price, you might have a business broker, you might not. There's certainly usually no private equity involved. It's too small. And so that's where your example of the family, the child with neurosurgeon, these things come into play more when it's a smaller business, one location, handful of employees, and the deal size is small like that. And at the higher end of the market, and also I would say when financing, non-SBA financing is more prevalent, and this is both strategic and private equity, but probably more often private equity, I am seeing an increase in seller financing and an increase in equity rollovers, both. And so the seller financing is just the concept is deferred purchase price. And so they might say, well, just, we're going to pay you $1 million a year for 3 years after we close, in addition to the 10 million we paid you at close. And they might call that an indemnity holdback, or it might be called a promissory note. Same idea. We'll pay you later, right? We'll pay you Tuesday for hamburger today. And by the way, if a surprise liability pops up, we'll take it out of that. And then the equity rollover concept, which can be, I've seen it be very lucrative for founders. But the idea there is they say, if you want to, instead of paying you 100% for your business, we'll pay you 90%. We'll let you take 10%. We'll roll it over, and you can, whatever that value is, we'll turn that into stock of the buying company or the parent company. And that means that you get to go along for a second bite of the apple, because we're in the middle of buying one business every 3 months. And if you sit around for 4 or 5 years, that 10% you rolled over might be worth, who knows, 5 times what it was worth.
Mm-hmm.
And so I've seen that happen. I've seen it work out where the founder made a lot more money on the rollover. So that's becoming a common thing. And you can see why also when the buyer's hiring the founder, it really does align the interest more so than just saying, here's an employee stock option that's going to vest over 5 years. You say, actually, no, this is like a multi-million-dollar rollover. You could make a ton of money if we all make money. And so it does a great job with the incentive and aligning interests and giving the founder a reason, even though they just got a bunch of money to keep coming to work every day.
Yep. Good insights. I'm learning a lot here. Katie?
Yes, absolutely. That is all of the questions that I had for you, Addison, and thank you. Your answers were great. I learned a lot as well. As Stan said, is there anything you want our listeners to know about that we didn't cover today?
Just that we're accepting new clients, and we're also happy to talk to anyone in your audience to answer any questions. I understand that you do have a number of professionals as listeners that are in my ecosystem that we don't do as lawyers, of course. And so that would be CPAs and wealth advisors, that kind of thing. And these founders, they need that kind of help. And so we're happy to get to know more people and expand. I like to always expand my network. So anybody that would like to reach out to me, you can find me at my website, which is adamscorporatelaw.com. We're a small firm under about 10 lawyers, and we're all focused on closing deals, writing contracts, and everything we've been talking about. So there's a lot that we don't do. We're not a full service litigation firm. We don't do estate planning. The long list of things we don't do. What we do really well. And I hire the best people to do it. You can reach me on my email, addison@adamscorporatelaw.com. You can also give me a call. Just pick up the phone. I am old enough to still have a phone and use it. My phone number is 714-619-9360. Look forward to talking to anyone. Thanks so much.
And
I appreciate
we'll put all of
me.
that. Yeah, we'll put all that in the show notes too. So if you didn't write that down, because you probably were driving down the freeway and couldn't write it down, that'll all be in the show notes.
Yes,
Wonderful.
absolutely. Well, thank you for all of our listeners for joining us. This has been the Legacy Leaders Podcast with your hosts, Stan Miller and Katie Beth Hand. And our guest today has been Addison Adams. As he said, for more information on the work that he does, you can visit adamscorporatelaw.com. We will also put that link as well as his phone number and email address in the show notes so that you can reach out to get connected. Addison, thank you again so much for joining us.
Thank you both. What a fun time. Have a great day.
You've been listening to the Legacy Leaders Podcast with Katie Beth Hand and Stan Miller. For more information on them and the show, please visit pinnaclelegacylaw.com. If you like what you've learned today, do share the program with your friends and subscribe wherever podcasts are found.